and welcome to a special Diwali show, Citi on India. And my guest on the show today is Pankaj Vaish, Managing Director and Head of Markets with Citi South Asia. Pankaj, what a delight to have you on the show. Thank you for joining us.
Pleasure to be here.
Let me first start with the moot point, which is the outcome of US presidential elections. First, what it means for you and me, and then what it means for the rest of the world.
There, the big issue is obviously the economy. And so the economy is coming back from a very deep recession. And it has done it on the back of two important things. One is the tremendous monetary stimulus. And for that, the Federal Reserve has obviously pulled out all stops. Now with Mr. Obama getting re-elected, obviously it looks like that policy will continue because Mr. Romney had very openly said that he would call that into question. So I think there's relief for markets from that front. The other is the fiscal spending. That is very large. The gap between tax revenues and spending is about 7 percentage points of GDP for the last year. Those are very large numbers. And there, I think there is some sort of despondency growing within a lot of adults saying, how will this sunset? How will this improve? I think everybody understands you don't want to have a very harsh turnaround to that, because that will call into question the recovery. But yet, broader ideological questions in terms of what do we do about the spending and the deficit and the entitlements that have increased over the years. So that, I think, is an important debate. And frankly, that's not just restricted to US. I mean, in India, we have questions, right? And I'm sure we'll talk about that about spending here. And in Europe, I mean, everywhere, that is an important question I think the whole world is grappling with right now.
So if I map the year 2012, it's central bank policy action and Europe, along with China. These are three things which have dominated global markets. What, to your mind, will dictate and dominate global markets for next 12 months?
For the next 12 months, I think the policies taken by the Federal Reserve and ECB are probably the single most important things. So if that continues the way that Mr. Bernanke and Mr. Draghi have been talking about it, then I think for the next 12 months, those are supportive of risk, they are supportive of asset prices, nominal asset prices, and that will continue. I have to say Mr. Draghi has done a tremendous job. When he came in, I think the general thought was he'll just be an incremental shift from Mr. Trichet, but he's been remarkably different and has been quite clear in terms of doing whatever it takes to save the euro, and frankly has also, looks like, managed to persuade Angela Merkel to agree with a lot of what he's saying. So that's a pretty dramatic turnaround. I think that is a very big part of how the markets in Europe recovered this year, and the currency. Then, of course, the fiscal spending. If US is staring at a very large fiscal cliff, as everyone calls it, how will that get resolved? Mr. Obama pretty much needs to go back to work again tomorrow, because these automatic cuts and tax raises come in. And I suspect some Republicans are not going to be in the most collaborative mood after this election. People will be upset because the popular vote is very close, while the electoral vote is nowhere near as close as we were all thinking it would be. But the popular vote still is very close, and so people feel that just continuing with what has been going on for the last 4 years on economic terms will obviously be contested by the Republicans.
So between China, Europe, and US, which economy do you think would be the dark horse, which could surprise us on the upside? Where do you see genuine growth will come back the fastest and the slowest?
So, I mean, among those three, obviously Chinese growth in an absolute rate is still the highest, but it has had a sharp deceleration. There was a serious concern whether this can turn into a hard landing in Chinese terms. I mean, we're not talking about negative GDP, but let's say 5–6% would be a hard landing. It looks like for the time being they have saved it. It looks like for the time being some of the policy measures that have come into place have helped stop the downward spiral. The US economy looks like it's in short-term GDP growth terms looks decent. The housing market by some knowledgeable people's account, looks like 2011 was the low and 2012 is building on top of it. So that looks like it's in a decent recovery. Corporate balance sheets are actually in great shape in the United States.
US corporates.
US corporates are in great shape. Our US analysts say that even for this third quarter, earnings have been very good. About 71% of S&P 500 companies have beaten expectations, and by about 3.5 or 4 percentage points. So that's a pretty good number. So I think US corporates are in good shape. US household balance sheets obviously still need to recover and be repaired a little bit. Among those three, in terms of versus expectations, I think US can still do quite well. Europe will still need time to muddle through.
So next 12 months, do you expect will be a good time for financial market investors, or it will be a challenging time?
I think next 12 months will be a good time for equity markets, mainly because of the monetary policy stimulus. What that does is just kind of keeps this very important support from people with, in some sense, limitless resources. I mean, obviously, even a balance sheet for a central bank vis-a-vis GDP has to hit some ratios, but still, extremely large resources. And that gives a lot of comfort to nominal asset prices and risk. I do hasten to add that I still have my very serious concerns about the longer term issues in terms of debt and entitlements. And it makes me quite worried about the future and how we're going to be paying for all of this stuff. But for the short term, let's say a year, 2 years, that strong support and strong, quantitative easings are helpful for risk assets.
Where does India fit in? Indian markets are up for more than 25% this year. We are the best performing BRIC market so far this year. So how should long-term investors now approach Indian equities?
See, long-term investors, I've maintained all along, should stay positive, because it is a country where you will get, in some, let's say, mid-double digits earnings per share growth from Indian top corporates. So there, I think it's probably a waste of time for people, for long-term investors to worry about every squiggle. Our amplitudes of market movements have come down. So in 2008, we sold off 65%, even though the epicenter of the crisis was thousands of miles away. I think we have learned, as I keep saying, system learns from prior experiences. And the sell-off in the 2010 Europe crisis was smaller than that. 2011 was lower than that. So these plateaus have continued to rise. And even in December of last year, when we did our 2012 calls for our clients, we had said that 12 months is a very long time. The entry points are excellent from bond yield perspective, from equity market valuation perspective, from the rupees point of view. So the entry levels were very good. And this is our track record last fall was we were quite negative on the market. So it wasn't just sort of a bullishness. But our view was basically that the entry points were very good. And we've maintained that even in June when we did our investor conference. Even though the market had yet again come back to 4,800 or 4,900, our view was strong. We think the market will do very well into year end. And in fact, we've raised our price targets further. And in late May, June, I was asked this question that when do you think the market will go hit a new high? And I had given the answer between May 2013 and 2014. So between elections next time to a year before that, somewhere in there. And at 48,900, it looked like a pretty crazy call. But our view has just been, despite the policy slowdown, the massive slowdown that was going on that time, just the corporate fundamentals were so strong that this will be okay. Plus, cyclically, I feel obviously interest rates had peaked and we will go through an easing cycle. So that'll also help over the next 12 months. So our view was that the markets will do well. That's for long-term investors. For guys who worry about what the next 3 months will be like, by the way, I still maintain that markets will go make a new high between that May 2013 and 2014 period.
Would you like to prepone the time period now? Because we're almost there, less than 10% away from an all-time high.
But there are lots of roadblocks. The easing looks like deferred for a whole bunch of reasons. And also on the policy front, while the mid-September announcements were very impressive, and I was especially heartened to see the finance ministry and the rest of the government really stick to the guns and say no rollback in the 5 rupee diesel price hike, no increment on the LPG cylinder issue, and every week they were coming out with new bills. That was, with new policy pronouncement. That was impressive. Now with the Himachal elections last week and the Gujarat one coming up, I hope there's no wobbliness on that determination, because that did win kudos to the policymakers, and certainly a credit rating downgrade was just would have been silly. So I hope that that's been permanently put out there. But it's very important to keep that steely resolve. Very, very important. That there's no sense of dithering in the face of political or electoral issues, because we were close there. I mean, the currency was getting really weak, as I've said time and again. The currency is what puts the fear of God in global investors. More than they can withstand a 20% sell-off in the stock market, they can take a 10-point drop in prices in government bonds, which is very large for government bonds. But currency, and if it looks like there's some loosening of control over the currency, that really worries people.
But I like your quote there, that currency fall reminds you of God. So certainly would like to archive that comment. But do you think Indian markets have a base in place? It could be 5,000 on the Nifty, it could be 16,500 on the Sensex.
Yeah, I think the low that we saw this year, 4,800, 4,900, yeah. I feel that we should be slowly making a path towards the old high, towards 6,200 on Nifty.
What about currency? What do you think could be the range for Indian currency for next 6 months?
Well, again, if we can keep the steely resolve, I think we should trade back down towards the 52 level, because that's probably where it belongs, even on valuation, on exchange rates versus our trading partners. And for people looking for investment opportunities in India, it's a great entry point in these mid-50s. So I hope if we can keep that resolve, also if once the RBI is in the same cycle, I don't see why rupee should not go back down towards, dollar rupee should not go back down towards 51, 52.
Is that your long-term target as well?
So we put out an official target. Citi puts out an official target. That too is in that direction. I don't remember off the top of my head what's the exact number that we've put out. It's on our website. But yeah, directionally, I just feel that that the rupee probably belongs at a higher level than where it is now.